Well, good afternoon, everyone. Thank you all again for being here today. Thank you for that kind introduction. It's a pleasure to be here. Again, my name is Joey Von Nessen. I'm a research economist, and I like to summarize the work that we do getting started to provide some insight into really what we're always looking at. And I say this half jokingly, I use this term half jokingly, and some of you may have heard me use it before. So what economics? That's really the theme that underlies all the research that we do, because we're always looking at economic data and asking the question, so what? How can we use economic information and metrics that we see coming out on a regular basis to help businesses and organizations make good strategic decisions? That's really our MO, what we're all about. And of course, anytime you're looking to make a strategic decision, the first thing you have to understand is the market environment that you find yourself in, the economic landscape. And so that's what we're going to be talking about this afternoon. The current economic landscape in September of 2024, how we got here, some of the trends that we've been observing over the last several years since the pandemic, and then what our expectations are about the rest of 2024 and looking ahead to 2025. How do the trends that we've been observing over the last several years, and especially this year, help inform us about what expectations are for the future, for the rest of 2024, and again, into the new year. So as we start out then, as we try to get a broad picture about what's going on in South Carolina and for the U.S., it's helpful, I think, to start by just giving the economy a grade. Right? How would we rate the state of the economy in South Carolina and at the U.S. level? And I'd suggest to you that we can start by rating the economy with a grade of B+. Now, why would we say that? Why a B+? Well, overall, if we look at most economic metrics, we have still seen a very resilient economy in South Carolina and across the U.S. that has persisted into 2024, up through where we are today. And we can see that in terms of steady consumer spending, which is the bulk of economic activity. We see that in terms of steady employment gains, a healthy labor market overall, and solid wage growth as well. So all of these metrics point to a picture of a resilient economy that has persisted throughout the year. But at the same time, we also are seeing the effects of inflation and high interest rates. And as we all know, inflation has had a significant impact on business and for consumers. Inflation is really the one metric that nobody can get away from, right? It's one of the worst parts about inflation is it literally affects everybody. We all see it in our everyday lives. So consumers and households have seen their purchasing power eroded over the last several years. And so that is clearly a weak spot in terms of where we are in 2024. So we can't have a grade A economy if we're seeing consumers lose purchasing power, even if by most metrics we're continuing to see growth overall. So that's why we start with a B+. And on top of that, we're also seeing in recent months the fact that the U.S. economy and South Carolina are beginning to lose some momentum, which I highlight here. What does that mean? Well, that's especially pronounced in the labor market, where we've begun to see a slowdown this year. And you can easily see that if we look at some of the changes in the employment rate, and the unemployment rate rather, both at the state and the national level. So a steady uptick so far this year, and that's especially pronounced in South Carolina, where you can see the unemployment rate jumping from 3% to 3.9%. It's almost a full percentage point difference between where we are today and where we were back in January. So a clear slowing of the labor market, and that also begs the question, is a recession imminent? Right? We are seeing the resurgence of recession concerns that we hadn't seen late in 2023 and early in 2024. So what's the answer to that? Is a recession coming because this labor market is slowing down? Well, the short answer is not immediately. So when we look at these data and we see a slowdown in the labor market, it's important not to panic. And sometimes that happens when we see upticks in unemployment. And there's a very specific reason why that we're going to talk about. And to set the stage for that and to really think about where the market is going, I want to step back and talk first about some of the changes we've seen over the last several years. So a healthy economy with a slowing labor market, what does that imply for the future? But before we get there, we need to step back and look at some of the broader trends, because that'll help us answer that question about the likelihood of recession. And so to do that, we want to start by stepping back and looking at the evolving landscape basically since 2020. We've been in a new economic paradigm that I like to call the Great Readjustment, right? Not the Great Recession, which we remember from 2008, or the Great Expansion, which occurred from 2010 to 2020, but rather the Great Readjustment. And this is a period where we've seen a disequilibrium emerge between supply and demand, where we've had demand far outpace supply, which has led to increased prices in the form of higher inflation. And now we're on the backside of that. We're going through a readjustment to get back to an equilibrium between supply and demand, moving back towards equilibrium after this disequilibrium emerged in 2020 and in 2021. And this is a multi-year process. That's an important point. When we look at this Great Readjustment period, I'm going to show you some data in a moment to illustrate this, but this is not something that's happening over a period of months. This is a multi-year process that we're going through. So how can we observe that? Well, first of all, if we look at the difference between supply and demand and how that emerged, a big piece of this was on the demand side in terms of high levels of consumer spending that emerged in the aftermath of the pandemic because of a rapid labor market recovery and $6 trillion in stimulus in 2020 and 2021. And both of those had the net effect of putting consumers in a very good financial position and allowed them to begin to spend. We see that on the labor market side. People go back to work, they earn incomes, which they're able to spend, and then they had access to $6 trillion in stimulus. Many households had direct access to those dollars through stimulus checks, through enhanced unemployment insurance benefits, through tax credits of different, a variety of different types of tax credits. And so you put all that together, and consumers were in a very good financial position and able to generate high levels of demand. And this is very easy to see if we actually look in the data. We can look at both very briefly. So first, looking at employment gains in South Carolina, and you can see the rapid labor market recovery in 2020 and 21, after we lost about 15% of our total employment base in South Carolina. And then we continued to see growth ever since. Continue to see employment gains, not just until we fully recovered from all the losses, but we've continued to see employment gains even since that time. And up through 2024, on average, you can see over the last 3 years, employment growth in South Carolina has actually been higher than what we saw during the previous decade. And employment is a very important metric in all sectors, but particularly in the housing market. It's the single biggest driver of housing demand. So it's important to keep our eye on employment levels. And as you can see, again, employment has been very strong in terms of overall growth in South Carolina. We can also see the effects of the $6 trillion in stimulus. You might think, well, how would we observe the effects of that? Well, we can simply look at income levels for households, for consumers. And so if we look at personal disposable income, again, you see a very clear pattern here, right? So a significant uptick in income levels in 2020 and 21. A lot of this has to do with the stimulus checks. And you can see it peak and then begin to come back down. And now today, disposable income is on par with pre-pandemic trends. So think about this Great Readjustment, right? We're going to go back to that theme multiple times this afternoon. You can see the adjustment in personal disposable income. Now, a couple of key takeaways here. First of all, when you're looking at income levels, the fact that we're continuing to grow at about the rate that we were seeing before the pandemic, and we've readjusted, that shows us that consumers and households, on average now, not better off necessarily, and not better off than they were a year or two ago because of the effects of inflation. They've been having to spend down these excess financial resources to continue their existing levels of spending activity overall. But nevertheless, they're still in a fairly good position relative to where they were before the pandemic began. And that's very important because, again, that feeds consumer spending. It helps us predict what consumer spending is going to look like. And as a result, we see consumers in a fairly good position here. Also note that when we're looking at personal disposable income, part of the reason for this is that the stock market has been doing so well. Because you might step back and say, well, inflation has been so high, we've seen purchasing power reduced. How is it possible that disposable income levels still look pretty good? So this is a combination of factors, but the stock market plays a key role here and is one element of why we continue to see consumers in a fairly good position. And this translates into consumer spending itself, which we can take a look at here. Again, you see a quick recovery and back to pre-pandemic trends, which is what we want to see. Consumer spending has been very steady ever since then. Now, is this the whole story? Well, the answer is no. We have to look a little bit more in depth at consumer spending, especially because we really want to get a sense of which sectors have had the most disruption following the pandemic. Again, that disruption between supply and demand, that disequilibrium that emerged. And you don't really see it here, but if we scratch beneath the surface, you can get a better picture of what's going on, and it gives us some insight into what's been happening for housing markets and in South Carolina. So if we look at consumer spending, we can break it down into the goods market and the services market. Okay, so here we're looking at consumer spending as a whole, but we can break it down, and then a very different picture emerges. Right? So we saw pretty stable consumer spending as a whole in the aggregate, but when you break it down, a very different story. Specifically, we see a durable goods bubble that emerged. A durable goods bubble. And this explains a lot of what's happening in South Carolina and what's been happening over the last several years. Because what markets are contained within the goods market and the durable goods market in particular? Well, housing is a big one. Manufacturing is another big one. And so when we look at the spike in goods spending, followed by a tapering, a deflating of that bubble, that correlates with what we've seen with housing markets in South Carolina and also what we're seeing with manufacturing. And what's happening is in 2020 and 2021, we think about all of those consumers that have all these excess financial reserves as they went back to work, earned income, had access to these stimulus dollars in a variety of ways. They're spending this money, but they're mostly spending it in the goods market, right? Because we're all socially distanced. We're not going out to eat. We're certainly not getting on an airplane. And so you see a significant stimulus effect in the goods market as we see more consumer spending in goods and less consumer spending on services. And now we're in the process of readjusting. Again, get back to that great readjustment period. That's especially pronounced in the goods market. We are almost there, but still the goods market is slightly above trend. Services has largely recovered. So this is an ongoing process that we're seeing. And as I mentioned, it has an effect on housing and in manufacturing, especially when we look in South Carolina. So when we summarize really the good news, the good components of where our economy is, we can say that we've been very resilient. We've had very steady rates of consumer spending. We have household financial resources that are stable. And as we saw, we've had a very healthy labor market, right? So employment growth has been fairly solid over the last several years. So that's the good news. But we also have to talk about some of these effects that have come about from high inflation and also the loss in purchasing power that correlates with that, as well as high interest rates, right? So we've got good news, and we've got that element that keeps us from giving the economy a grade of A, right? We talk about a B+ because of this loss in purchasing power. So we can see this very easily if we look at what's been going on with the consumer and with businesses. So let's start on the consumer side in terms of how we can observe this loss in purchasing power and just how significant has it been. Well, one way to observe it is just to do a direct comparison between total inflation and total wage growth over the last several years. Okay, so this is not a one-year comparison. This is a 3-year comparison. Okay, July of 2021 to July of 2024. Right, so looking over the past 3 years overall. Notice first, the bottom 2 bars here, average hourly earnings, again, on average, how much growth have we seen, versus the U.S. inflation rate over the past 3 years. So clearly you can see the loss in purchasing power. Inflation or prices have risen faster than wages. But that's not the whole story. right? We can't just look at overall inflation. We also have to look at the goods and services that consumers are facing and are purchasing on a regular basis, right? So just what type of prices do you see every day, or at least every few days? And the answer is pretty simple, right? Food prices and energy prices. So that's a better comparison when thinking about what consumers are seeing on a regular basis. So we can just compare those, again, the top two bars there, and you can just do, once again, a direct comparison between average hourly earnings and what these price levels have looked like, how they have changed over the past 3 years. And you can get a very real sense of the degree to which we've seen consumers lose purchasing power in recent years. Now, the other element here, the other important component when looking at the changes in purchasing power is to compare what we're seeing here to looking just at the last 12 months. All right, so we've looked at the last 3 years. Let's look at the last 12 months. And we get a picture that's a little bit different, right? So we actually hit an inflection point last year where inflation it's been steadily coming down, and it hit the point in late 2023 where wage growth began to exceed price growth or growth in inflation. And so if we just compare the most recent 12 months, you can see a pretty big difference here where wages have been growing faster than prices. Now, why is this so important? Because you can now compare the two. And so if you look at this, let's go back to the previous slide and look at these data one more time. So what's so interesting here is that even though we've had a year, the most recent year, where wages have been growing faster than prices and consumers have been clawing back this loss in purchasing power, right? Even with that full year, it's still not enough to undo the loss in purchasing power overall that we've seen over the last 3 years. Right? Does that make sense? And how do you see that? Because this here, these two numbers, takes into account the gains in purchasing power over the last 12 months. So this comparison here already factors in the fact that wages have been growing faster than prices over the last 12 months. So it just shows you the extent to which consumers have lost purchasing power, despite the fact that inflation is now back down closer to 2%, and that consumers are beginning to claw that purchasing power back. And I would suggest to you that comparison that consumers are making and what they're seeing explains most of the reality that consumer sentiment continues to remain low compared to where we were before the pandemic, right? Because otherwise you would say, well, the economy looks like it's doing fairly well, again, overall. So how is it possible that consumer sentiment is so low compared to where it was before the pandemic? And again, that loss in purchasing power, I think, goes a long way towards explaining it, because it's very hard to feel good about the economy when you're being financially squeezed. And so we see evidence here of what consumers are, how they're rating the economy overall. And again, it goes back a lot to what they're seeing every day at the grocery store and at the gas pump in terms of changing prices. All right, so let's talk a little bit more about what's going on with businesses. We talked about the consumer side in terms of these effects. On the business side, we can talk more about inflation, but also about rising interest rates and how that's had an effect in South Carolina, and particularly on housing and manufacturing. Because housing, I like to say, has really been on the front lines in this battle against inflation that we've seen, because when interest rates rise, housing markets are typically hit first, and they're typically hit hardest because it's the most expensive item that most consumers are going to be buying. So we've seen a significant pullback, but again, the good news here is that a bulk of this readjustment that we've been going through is behind us. Think back, again, the great readjustment period. Think back to that durable goods bubble that we looked at, right? So we're not fully readjusted, but we're getting much closer. And we can see that whether we're looking at the aggregate level for the durable goods bubble as a whole, or if we look specifically at markets that are goods markets that are subsectors of that durable goods bubble. Again, housing and manufacturing. So let's briefly look at a couple of trends in both markets to just illustrate this point. So let's start with what's going on in housing in South Carolina, just to give you a sense of what sales activity has looked like for the last several years. And this is annual growth rates going back to 2017. So the black bar there is 0% growth. And if you kind of squint a little bit, you can see that durable goods bubble, right? In 2020 and 21, we see sales activity go up, growth rates go up, and then you see a significant pullback beginning in 2022, right, when the Fed starts to raise interest rates, right, to start combating inflation. And there's a very strong correlation here. Again, the first interest rate hike that occurred in March of 2022, and right about that time, we began to see negative sales activity in South Carolina for the first time, which persisted through late 2023 into early 2024, but it has leveled off. It's leveled off. So the bulk of that readjustment is likely behind us. And again, depending on the time period of comparison, we've actually seen positive growth in total sales volume in South Carolina. Again, not by much. It's been close to zero, but we've moved away from this significant contraction that occurred in 2022 and 2023. So again, part of this great readjustment that has continued and that we're getting on the backside of. Now, we can also see a similar picture for manufacturing, right? Once again, you can see the durable goods bubble, right? The manufacturing component of it. Same general trend, right? An uptick in activity in 2020 and 21, followed by a pullback and some stabilization in 2024. The correlation not quite as strong with interest rates, but it's still there. And the reason is fairly simple and straightforward. It's because, again, when we look at housing markets, that's the most expensive item that consumers are buying. So manufacturing is affected, yes, because when interest rates rise, the cost of a vehicle goes up, the cost of an appliance goes up, right? Anything that you have to borrow money for rises, but it has a bigger effect the bigger the item when we're looking at big ticket items overall. So we don't see quite as much of a relationship there in manufacturing, but overall the trend still holds and it's very clear. And we're seeing that readjustment. So this is the manufacturing component of the great readjustment of the last several years. And then finally, we can also take a look at housing and get one other element out of these data that we are tracking that really doesn't show up when we just look at overall trends in sales. And that's this other effect of pricing, right, which we haven't really addressed yet. What's going on with housing prices? And we can see some significant changes, again, in the last several years following the onset of the pandemic. So again, we can compare the first interest rate hike and notice the effect, right? The effect on sales, which we've already seen is immediate, the line in red there, compared to what's going on with the median sales price in South Carolina. So I would say there's a very different effect there. We've seen a decoupling somewhat of the trend between growth in sales, or between changes in sales, I should say, and changes in price levels. Right? Normally, we expect those two to go together. When you see an increase in sales, an increase in demand, that puts upward pressure on prices, and then vice versa. But something changes in 2020 and 21, and especially in 2022. What are we missing here? What's changed? And the answer is inventory. A lack of inventory that has been building up for over a decade now has begun to really have an effect that we can see in terms of these pricing changes. So beginning in the aftermath of the Great Recession in 2008, we began to see many builders go bankrupt. We see others that are more skittish about getting into the market because of low initial demand and new regulations that are introduced. And so as a result, even though the population in South Carolina continues to grow at a steady rate, we see underbuilding, not enough inventory, not enough new construction for that steady population growth that was continuing throughout the last decade. Then we fast forward to 2022, and what happens? Interest rates go up. And what does that do? Well, it makes existing homeowners far less likely to want to sell their homes, right? Because now, if you're locked into a 2 or 3% mortgage interest rate, and you have to swap that out for a 6 or 7% mortgage interest rate, that's not so attractive. And so we've got two elements here that are contributing to low inventory levels. And so the bottom line here is that when we see a pullback in demand because of rising interest rates, the lack of inventory is overpowering that drop in demand. In other words, there's a decline in demand, but the low supply overpowers it, and so prices didn't drop, or at least not significantly so. We see prices continuing to rise, just not at the rate as strong of a rate as they had been. So the supply effects are simply larger than the demand effects because of that decade-long period of underbuilding that we have observed. And one way we can see this on the mortgage interest rate side is just to compare what's been happening with existing mortgages versus the current 30-year mortgage interest rate. So this really gets to that existing home buyer who is really not looking to move if they don't have to. And for the first time in a decade, beginning in 2022, we see 30-year mortgage interest rates go above the average rate that existing homeowners have. So what that 4.1% means on the right-hand side in 2024, that 4.1% says that the average existing mortgage in the United States is at 4.1%. That's the average rate of existing homeowners. So on average, we see the US homeowners comparing a 4.1% rate that they currently have to 6.5%, and in some cases higher, right? So that's actually come down recently. So that's not so attractive, and it's a big, big difference from anything we had seen in the last decade, right? So this just has practical effects in terms of impacting inventory levels, and that also helps to explain why we see things like this. Construction activity in South Carolina, construction employment growth specifically. What do you notice here? In 2022 and 2023 and 24, the last several years, we don't see hardly any significant pullback when interest rates rise. Again, how can that be? How can it be possible that with this pullback in demand and the lack of sales, which we have seen, how does that not translate into less overall growth? Well, it's because of the lack of inventory. We continue to need new construction. And so construction is continuing to move ahead, even though demand isn't as high as it was just a couple of years ago. So the supply and demand imbalance is significant. And again, it's very easily seen when we look at the data. And this is not a short-term challenge that we're facing. We've had a period of underbuilding that is going to continue to affect markets going forward into 2025. So let's change gears then and actually talk about the future. What does all this tell us about next year? What does it all tell us about the second half of 2024? So let's go back and summarize. Remember, we said we have a B-plus economy that's doing well overall, except for the fact that we've seen consumers lose significant purchasing power. Businesses are facing higher interest rates and in many cases higher prices as well. And when we look at more broadly this great readjustment, we can see the biggest effects are in the durable goods market. And in South Carolina, that means housing, as everybody in this room is well aware of, and manufacturing. So what can this tell us about the future? Well, first let's go back and talk about that recession question again. Remember, we started off by saying that we're beginning to lose some momentum. And these fears of recession have really resurged. And we see this in the media a lot, speculation about what's going to happen. And so why is that the case? These increased unemployment rates are all of a sudden creating a problem, even though really they've been rising all year. So why in the last 30 days or so have we seen this panic, and especially translated into the stock market, right? We've seen a lot more volatility that we didn't see earlier this year. And I would suggest to you that basically it boils down to the fact that we saw a couple of news notes in a very short period of time that basically spooked everyone and spooked investors specifically. So if we go back to July 31st, we had a report come out. Jay Powell, the chair of the Federal Reserve, came out and said that the Fed chose not to lower interest rates, right? That it's too soon. We're not ready to do that yet. We don't really feel comfortable that inflation is yet under control. And so everyone's digesting that information, right? 2 days later, the unemployment rate comes out for July, and it jumps to 4.3%. And if you haven't been paying attention, 4.3% is the highest level that we've seen the unemployment rate at going all the way back to October 2021. So we see both of these news releases in the span of 2 days, and everybody panics and says, oh no, the Fed waited too long. We're going into a recession. The labor market is cooling, and Jay Powell has missed the boat. right? So that's the panic that sets in when we get this data up very quickly. So did the Fed wait too long to act? So let's talk about that. Did they miss the boat? Are they too late? Well, let's go back and think about what the Federal Reserve's goal is. They have what we call a dual mandate of price stability, meaning keeping inflation down, and also maximizing employment. And the problem with the dual mandate of keeping prices down and employment levels high is that you have to move interest rates in both directions, right? If you want to keep prices down, you have to raise interest rates, right, to make the cost of borrowing money more expensive. So that'll cut down on consumer and business spending and lower demand. So you raise rates to get prices down, but you have to lower rates to stimulate the economy, right? And to get businesses to hire and to create a better job market. So the Fed has to focus on both of these and basically walk this tightrope to keep interest rates at the ideal level that satisfies both of these concerns. And over the last 2 years, they have been almost exclusively concerned with problem number one here, right? With getting inflation down, because it has been at a 40-year high, which again, we can very easily see in the data. 9.1%, a 40-year high in inflation. That's a one-year number, year-over-year inflation. We've seen steady progress since then, though. Inflation now down to 2.9%, the current overall estimate. And so the Fed is looking here and saying, okay, well, we're getting closer and closer to our target, which is this black line here of 2.0%. That's where Jay Powell wants us to be. That's what the Fed sees as price stability. So we're getting closer. We're inching closer, especially in the last year. You can see we've really stabilized at around 3%, but slowly, we're getting closer to 2%. And so the question is, when are we going to get more confidence that that trend is continuing? And here's a not often quoted statistic that I'll share with you, which is one reason why the Fed is now more confident. Just like we break down consumer spending into the goods market and the services market, we can do the same thing for prices, for inflation. And so here, we're just breaking down inflation into inflation for goods and inflation for services. And for the first time in several years, just in the last couple of months, we've seen inflation in the services sector drop to 2.0%, which is where the Fed wants it. The goods market has been there for a while, but the services sector just now getting there, which means that the Fed can step back and say, okay, inflation steadily going down, and this one component that just is stuck and will not move is beginning to go down as well. So we are now in good shape. We're very confident that we have inflation not solved, inflation problem is not licked, but we're getting closer. And they have more confidence that we're going to continue to see inflation drop to 2%. So they say, okay, well, we've got this major problem, this price problem under control. Now let's go address the side effects, right? Now let's talk about the labor market. Because remember, we said interest rates move things in the opposite direction. So when you try to increase interest rates to get inflation down, you create these side effects. What are the side effects? Slower economic growth, right? Increases in unemployment, exactly what we've been seeing over the last year. And so the Fed is saying, all right, well, we've got these main symptoms under control. Now let's deal with the headaches, right? Now let's deal with rising unemployment. Now let's deal with a slower labor market. And again, you can see these effects very directly. We can see these side effects. So here's employment growth in South Carolina. We talked before about how employment growth has been very steady overall, and it has been if we look long run. But if we zoom in, you can see there is a difference, right, in the last 2 years. Since we started experiencing higher interest rates, we've seen employment growth drop from about 4% to about 3%. Still positive, right? So it's important to keep in mind, the labor market is still expanding, the jobs market is still strong, but it's not growing as fast as it was in 2021 and in 2022. And that's all intentional. Again, this allows inflation to come down. So this is part of what the Fed is intending, what they want to see. But the side effects are very clear and very observable. Another way that we can see it is to look at the job openings rate. So this is just a representation of the number of jobs that are currently available and unfilled. And again, look at the readjustment, right? The great readjustment. We see a significant increase when demand spikes. We're now seeing it come back down. And today, it's very close to where we were before the pandemic began. So another piece of evidence where we can see a slowing jobs market, slower employment growth, not as many job openings as there were a year or 2 years ago. And then finally, we can also look at unemployment insurance claims data, which is a very important metric because it gives us a sense of the number of newly laid off workers in South Carolina. So anytime someone is laid off from their job, they have the opportunity to file for unemployment insurance benefits at the Department of Employment and Workforce. And when they do that, they are considered an initial unemployment insurance claimant that first week, the first time that they try to apply for benefits. And so we can just track that, right? We can just count how many people are coming in requesting unemployment insurance benefits. And we just track that over time. And that gives us some insight into the number of newly laid off workers. So it's a very good representation of how the labor market is changing. So when we look at the trends, again, it bounces around a lot because these data come out frequently. But you can see that in general, the average is right on par or slightly lower than it was before the pandemic began. If we compare it to the weekly average rate between 2017 and 2019, for example. So what this tells us is that layoff activity is not any higher than it was before the pandemic began. So the bottom line then, when looking at these unemployment numbers, the numbers that will come out later this week and numbers that we've seen before, unemployment is rising, yes, but it's primarily due to slower job growth. It's not because of increased layoff activity. So think about it this way. What's happening is that we're seeing job growth, just not as much job growth. So when people come into the labor market, when people move into South Carolina from out of the state and they're looking for work, it takes them longer to find a job if we're not creating as many, right? If we're not creating them as fast. And so while they're looking for work, they're counted as unemployed. So we don't ever want to see the unemployment rate go up, but in a sense, this is if there's a good reason for the unemployment rate to go up, this would be it, right? It's just taking people longer to find a job. It doesn't mean that people are actively being laid off. So there's a big difference there, and that's an important takeaway when looking at these employment numbers that are coming out over the last several months. But we also have to keep in mind that there's no longer a whole lot of wiggle room left. The labor market has been cooling, but we're now basically to a sweet spot that if the labor market deteriorates further, or I should say an inflection point rather, if the labor market deteriorates further, then we may begin to see some uptick in unemployment insurance claims, an uptick in layoff activity. Why is that the case? Because, number one, excess savings have been exhausted. We talked before already, remember about disposable income and how that's come back down to pre-pandemic norms. And that's because consumers and households have been spending down the excess financial reserves that they had accumulated because of the stimulus, as well as because of a thriving stock market. And so if we just track that over time, you can see that these excess savings have dropped off. And again, as of 2024, basically they've been exhausted, which means that if we continue to see a slowing labor market, consumers are not going to be able to continue to spend, right? Because they don't have excess resources to draw on the way they did a year or two ago when they were facing high prices and they were able to continue to spend because they could have these excess financial resources that they could draw on. So that makes a difference. We can also look at the delinquency rate. Just look at consumer loans and how have delinquency rates changed in the last year. Again, we see a movement back towards pre-pandemic norms. Again, think about that great readjustment. They were down for a period when consumers were better off financially, and now that we've readjusted, they're now back close to where they were before the pandemic, or even slightly higher. So again, not a red flag, but maybe a yellow flag, maybe a warning sign here that we're beginning to see an uptick in delinquent loans, which suggests that the consumer isn't as healthy as they were, again, just a year ago. So we're getting to that inflection point, again, from the perspective of the Fed. So this steady consumer spending that we've talked about, again, very stable around a long-run average that is comparable to what we saw before the pandemic began. But if we want this to continue, the labor market has to be stabilized because, again, there's not a whole lot of wiggle room left for the consumer if we don't get that under control. So what is the next data point to look for? Tomorrow, Friday, September 6th, the August employment report to be released. I know you'll all be watching for that very anxiously tomorrow morning. And that will give us some insight as to what the Fed is likely to do in September, right? Because there's speculation that they'll lower rates by either 1/4 of a point or 1/2 of a percentage point. It could go either way. I think right now, the most likely outcome is 1/4 of a percentage point, but that will largely depend on what the data show tomorrow, right? So if we see a significant uptick in the unemployment rate or significantly lower job growth than what is expected, then we potentially could see a rate cut of 0.5 percentage points. So we'll see, but that's going to be a very important number to watch, and that's really the last big piece of information that the Fed's going to get before they have to make a decision when they meet in about 2 weeks. So a very important labor market report coming out tomorrow that should give us some insight into the Fed's next step. All right, so wrapping up, what can we say? Again, South Carolina's economy continues to be very strong and resilient. We've seen steady consumer spending that has persisted. The labor market continues to be very strong in South Carolina. And we've seen very strong wage growth over the last year as well. The weak spot, getting back to a B-plus economy, is this high inflation that has really impacted consumers' purchasing power, and that has had also an effect on businesses in terms of high costs and, of course, high interest rates. As we look ahead, recall that the goal of the Fed is to get inflation down to 2.0%. We're getting closer and closer to that target. So over the next, or for the rest of this year and into 2025, we can expect for the Fed to give equal weight to focusing on getting inflation down and to stabilizing the labor market. How is that different? Well, this time last year, they were almost exclusively focused on the inflation and on the inflation rate and said explicitly, Jay Powell has said explicitly that they will tolerate a recession if that's what it takes to get inflation down to 2%. They were that concerned about prices being elevated, that high inflation. That's not the case anymore. So they're equally concerned now with inflation and with unemployment, which is why we're expecting to see them cut rates in September. But, and I'll leave you with this final point, the goal of the Fed is to stabilize and not stimulate economic growth. Stabilize but not stimulate. Why? Because if they lower rates too quickly, then that can put upward pressure on inflation again. And remember, we have not solved inflation yet. We are not down to 2%. We're getting closer. We're moving in the right direction. But we have not hit that soft landing yet. There's still a lot of work to do there, and the last mile may be the most difficult. So we want to see the Fed stabilize the labor market, but we don't want to see any significant stimulus. So what does that imply for housing? Well, if we do see rates lowered, that could provide some stimulus for the housing market, increased demand, but we don't expect for the state's economy to significantly accelerate beyond its current level in 2024 and as we look ahead into 2025. So we are cautiously optimistic. We don't see a recession on the horizon, not immediately on the horizon, but we still have a ways to go before we hit this soft landing. So we can't rest easy just yet. So I will stop there. Thank you very much for your attention.
Let's start, guys, with Dr. Von Nessen just finished up. Let's talk about Columbia specific here. We've got mortgage, home building, supplies. What resonated with you, and how does it relate to you?
Well, for me, the first thing, a big thing that stands out is obviously the low inventory levels. That's what's contributed to the high home prices in 2020 when the mortgage rates bottomed out. You think about a pyramid, and at the top are people who can afford homes at a higher rate, and at the lower rate, more people can afford. And we drove many, many buyers into the market that sucked up all of the resale inventory and drove prices up. So, it's interesting that we're 16 years into it now. I guess '08 was a catalyst for it, and there's really no end in sight. So, higher interest rates are beneficial to help inventory levels, but at the same time, lower interest rates are necessary to help people as far as being able to afford the monthly payment.
Great answer.
Yeah, for me, being a builder, well, number one, in a low inventory market, it's great to be a builder. You directly control inventory, so I really latched on to that. That's been great for us, but on the mortgage side too, what really resonated with me is the indication that we're starting to see those rates fall, which again is great news for those home buyers who may have not had as much buying power that now do, or maybe they were trying to get into a certain price point, couldn't before, but now as rates go down, all of a sudden their buying power has elevated to a point where maybe they can get into that. So the inventory side and the mortgage side has really, in the last several months, benefited us for sure.
But probably the first thing is the great readjustment. I think that's perfect. Because from the supply side, we dealt with that as this thing accelerated, as we dealt with COVID. There was a real strain, there was a real challenge to get materials to supply the builders to build these houses. There were a lot of different factors, some directly related to COVID, from personnel, manufacturing, to just the fact that the one I found most interesting was a big surge in business in the boxes, in the Lowe's and the Home Depots put a challenge on lumber. I couldn't imagine that many people that you had to nail up 2 before you had to have a hammer or saw to be able to cut it. So that was an adjustment that way. Now we're seeing the adjustment, the reverse, where there's basically, there's an oversupply to a large degree. In fact, there's almost every few days you hear of a producer that's curtailing shifts or is closing mills because of a surplus of product.
Okay. Let me ask you guys, what would you say is the biggest challenge in your world right now?
The biggest challenge is, I think, is trying to understand exactly what the demand level is going to be in the near term. It's been probably the last several months in particular, it's been really hard to gauge exactly what the true demand is from a product standpoint.
Okay.
Yeah, I might even have to echo that as well. It's that fine balance between supply and demand for sure, especially on the building side, is how balancing how much do we open up, how much do we build versus what the demand is going to be in that. As a builder, you do walk a real fine tightrope with that. You don't want to build too much, then you have sitting inventory that's costing you money on the ground. At the same time, you're trying to sell things. That's a double whammy against you in a lot of cases. But I would definitely echo that sentiment there. There's a balance and a fine line that you got to walk.
Okay.
Well, thanks for the easy question. Mortgage rates obviously are my biggest concern.
Absolutely.
So, it's perception too. 1980, my mom and stepdad got married, bought their first house. They paid 18.5% interest, and about every 2 or 3 years they got to refinance because the rates continued to drop. We went from sub 3% interest rates to all of a sudden we jumped up to almost 8%, and so everybody just put the brakes on. They want to wait until interest rates come down, but then that's going to create another problem, because as rates come down, more people can afford to buy what we just talked about. I'm looking forward to seeing what the announcement is in September for rates, because we've already got baked into rates right now, a 2-cut expectation. So rates really won't do a whole lot as long as they make 2 cuts, because they're not directly tied to, the Fed makes a cut to the federal funds rate, not mortgage rates. They're indirectly tied together. So if they only make 1 cut, that's going to be bad for rates. If they make 2 cuts, no big deal. If they make 3 cuts, that'll be great for rates.
Okay. I would have to answer that question a little bit more personally. I've got a 21 and a 22-year-old, so I kind of look at it from the perspective of affordability, attainability. I'm not allowed to go into digging up other people's finances. I mean, that just, but you hear about more mortgage payments that are $2,200, $2,400, $2,500 a month, and that's just not the norm. There's just a part of me that believes that. I mean, that's just not sustainable. That's getting pretty high, and I'd have to say, I mean, there's a lot of things driving the lack of affordability, but regardless of what's driving it, that's definitely, I think, one of the biggest challenges we have out there.
Yeah, I tell clients a lot of times they have an expectation that they want a low mortgage payment and a big house. And so the reality is I tell them you're going to have to get comfortable with one of two things. You're going to have to get comfortable with a house that comes with the payment that you want, or you're going to have to get comfortable with the payment that comes with the house that you want.
Guys, how's your business changed in the last 5 years, and let's look at the next 5 to 10 years. What do you see?
From a builder's perspective, 5 years ago, don't tell anybody, I was with D.R. Horton. So 5 years ago, I was with D.R. Horton, and that was right around the time when we started to see getting close anyway, the whole COVID fiasco that we went through. So it was really, we saw housing demand just skyrocket and rise. In fact, at that time, we couldn't really even keep inventory on the ground. We couldn't build it fast enough. And now, all of a sudden, we've seen that slow dramatically. And so now here in Columbia, and I was in a different state 5 years ago too. Now here in Columbia, we are, to the point that was made earlier, we are starting to see that get back to some semblance of normal, but we're not there yet. So I would say it was great while it was, this is real estate speak, it was great while it was great.
Yeah.
And now we're having to readjust to a new norm, so to speak.
I would say not really 5 years, but closer than 5 years, probably what we've seen from a building supply position is that we're being asked to not only supply the material, but now we're being asked to supply the labor and install it as well. So that's been a huge shift in our part of the business, and as far as going forward, we expect that to actually increase.
Okay. And I've got an answer. I've got to say the last 5 years have been, with low supply, they've been great from a metric standpoint. Even though we've got our challenges, there's no doubt about that. I do sense a change going on, now, and I think we're kind of getting back to more of a seasonality. It's not 12 months of just, everything is great. Now it's more of a, January through, let's say, May, or, typically the best months in Columbia. And, I'm seeing the curve be what it used to be before. I guess pre-pandemic would be a good way to put that. Guys, as leaders in the industry, what's helped you get where you are? What advice would you give someone who's trying to follow in your footsteps?
I'm sorry, repeat the question. The beginning of it was.
The next one's even weirder. Repeat the question? Okay. Just as a leader in the industry, what advice would you give somebody who's trying to take the path that you've taken?
Don't do it.
Okay.
I
didn't expect that, but still.
I absolutely love what I do. I grew up doing abstract puzzles. I love the Rubik's Cube. So everything that I do every day is how to solve problems, trying to figure out how to make things work. So I absolutely love it. So I think that our industry over the next 5 to 10 years, we're going to do well. I think that the baby boomers that are going to be downsizing, they've got these big homes with very low interest rates. I think that lock-in effect is going to go away. So inventory levels will loosen up a little bit. So, and interest rates, I think, will come down. I saw that 4.1% average. I don't know what you think, Joey, but I think that the mortgage rates are going to come down below 5%, sort of hover in that range for the next 5 to 10 years. So I think it's a good time to get in. You know, you definitely don't want to get in at the beginning of 2022 and 2023, but I would definitely encourage it. It's a great industry.
Gotcha.
Okay. I would say learning to be resilient in these times is key, and that's always easier said than done. But in our society of Pop-Tarts and microwaves, everything is instant these days. And so now that we've had to make an adjustment, it seems shocking, like, oh gosh, you know, everything costs more, you know, we don't get to buy the big fancy house that we wanted to, we may not get to drive the big fancy car that we wanted to. So we're having to learn a new normal, but just learning to be, you know, especially if you're getting into home building, learning to be resilient through these cyclical periods of economy, I think is key to anyone, and not just in home building, but in anyone's success. You know, you gotta deal with the cards that were dealt to you, and just find a way to make it work. But in my world, it's just learning just to stay resilient no matter what's thrown at you.
I guess I'd say is understand really what it is you're doing from a standpoint of, you know, for us from a supply standpoint, it's servicing the customer and understanding that the customer is who you work for, and the success not of you, but the guys that are working with you. That's what it depends on, and be responsible to the people that you employ so that they have an opportunity.
And I would have to agree with what you said. I think you have to understand that this business is cyclical. There's going to be ups, there's going to be downs, but you know, I've seen, I started in November of 2005, and everything was just falsely, unbelievably good. And in 2008, all of a sudden, I don't think any of us really knew what was happening. I mean, it just dropped off of a cliff, especially where I was working, which was on the coast. And, you know, you got to withstand that, though. It felt like there were 4 bad years, but, you know, you just have to understand you can't quit, you can't give up just because you run into a recession or a bad time or a challenging time. You know, that would be my advice if somebody really wants to stick it out, because over the long haul, it's a great business to be in. Last question, and I did want to do a few Q&As if, you know, we got a little bit of time here. Maybe a weird question here, but if you got a book or a podcast or a technique or anything that you'd suggest to anybody in the crowd or anybody trying to follow in your footsteps, what would it be?
It would be any leadership book is to understand again and understand to help you understand what it is you do and what principles to apply to it, so that you establish yourself as someone that's basically a steady guy, you know, that's the same guy every day, and that leads people in the right direction.
I would say about 2-3 months ago, maybe, I finished a book with my group of chickens, so to speak, and we finished a book called The Wisdom of the Bullfrog. If any of you folks in here are veterans, that should resonate with you. I would say that what that book taught me is almost what I said earlier about being resilient. So this book really just deals with taking responsibility for your own actions and life, and doing good work with it no matter what circumstances thrown at you, and finding ways to the point that you were making, find a workaround to any hurdle or obstacle that gets put in front of you. And just, again, I hate to keep using this word, but being resilient in doing that. Life's not easy, and no one ever said it was going to be a cakewalk. We have difficulties every day that we have to overcome. It's the doing and the knowing and the working around those to make it work for us and everyone else around us that really sets the difference between us and everyone else.
Thank you.
So that's a hard one because I've read, a lot of books, self-help books, spiritual books. So I would recommend a series of, As a Man Thinketh, Power of Your Subconscious Mind by Joseph Murphy, The Science of Mind by Ernest Holmes, because those all talk about the importance of the thoughts that we think and how we create our reality. Anyone that is going to enter into this industry, I would recommend, Dave Ramsey, Financial Peace, because, 2008, I've been doing this 26 years, so I got in 1998, and 2008 when the economy crashed, I was married, had great incomes, my wife had a great income, we had 4 cars, 2 houses, credit card debt, and then our income dropped to nothing, and that debt rolled us right over. So, I've learned that debt is bad, savings is great, so I would say, no debt, save all your money, and that way you can ride out any kind of period like this.
Great advice. I think I would have to recommend, it was a book that I was forced to read recently. It's by Patrick Lencioni. It's a short read. It's not very long. It's a fable, and it's called The Motive, and it's really about, at the end of the day, it's about why people take the jobs and the professions that they take, and I see it every day, or often at least, you think that you need the next promotion just because it seems right. You think the person that you're interviewing, they want the job because it's got weekends off. I find people taking positions a lot of times for the wrong reasons. And, they don't truly love what they're doing. So if you don't love what you're doing, there's really no need to do it because it's probably not going to work out long term. So that kind of hit home with me. I know when I interview people, that's something that I definitely think about, and I'm kind of looking a little deeper to see, hey, what's the motive for this person? So, guys, I really appreciate the conversation, and we're running short on time, but, if anybody wants to ask any questions, feel free.